Welcome to our May 2023 Economic Update and Investment Outlook. I'm Ross Bramwell, a member of Hammerberg's investment team, and I'll be taking you through this quarter's presentation once again with my colleague, Ford Donahue. Usually, I cover political topics at the end, but given the timely nature of the debt ceiling negotiations, I thought I would give a few comments on the debt ceiling first. Although this weekend negotiations did not proceed as expected in finding any middle ground, we still believe the most likely scenario is that at least a short-term agreement, although it may be at the 11th hour and 59th minute, could be made to raise the debt ceiling for a few months with a framework in place on four main issues: rescinding unspent COVID dollars, work requirements for government assistance, a cap on annual government spending growth, and energy and renewables permitting. Some of these details may have to be worked out through the appropriations process. So once the details are worked out by fall, the debt ceiling could then be raised to get through the next election cycle. It may be likely that negotiations fail before they ultimately succeed. And the next week could be very tense, but as the leaders from both sides have now left it to their staff to work out the details, I believe that's a positive sign to get a deal done. At the beginning of the year, it was believed that the debt ceiling deadline would be in August. But as the two charts on the left show, tax revenues have been significantly lower than expected, which has created an unfunded gap for the government and has brought the X date, as announced by Janet Yellen, to early June. The chart on the bottom right shows the S&P 500 during 2011, when the U.S. was downgraded after the debt ceiling crisis in August. The downgrade moved the market lower by 10 to 15%. So if for some reason there is no resolution, this could be a reasonable move for markets. The S&P 500 has traded largely between 3,800 to 4,200 over the last year. Since we are at the higher end of that range right now, we would still be in a similar trading range if the market were to move lower due to the debt ceiling. Political events tend to create short-term volatility, so we do not expect to make any major allocation changes in the near term, as we believe that currently a deal will ultimately be negotiated. Now let's transition to the economy and markets. To start, I'm going to summarize the main points we'll discuss. The good news is that we have passed peak inflation. However, we believe it is still too high for the Fed to think about cutting rates. At 4.9%, the Fed believes it has much more work to do. And even if the market cheers a Fed pause in rates, we believe the recent banking crisis will have an impact over the next year, as banks have tightened lending standards significantly, which is reducing the credit available to consumers and businesses. This will keep the economy in restrictive territory. If you're watching economic headlines, there are many indicators that are broadly used to point to a recession. Almost all of them are flashing red currently, except for the job market, which has supported consumer spending. If it were not for jobs and consumer spending, we'd already be in a recession. But the Fed wants to see some weakness in the job market. The Fed believes that is the way to lower demand in its battle against inflation. It wants to see job openings decline as a sign the economy is slowing. In order to avoid a recession, the Fed would need to get inflation down, still without unemployment rising significantly. History indicates that may be hard to do, but so far the job market remains strong, which is supporting consumer spending. If we're now past peak inflation and pretty close to the end of the rate hiking cycle, however, the impact of rate hikes is still working its way through the economy. So what we are watching closely now is earnings, which are still expected to be barely positive for 2023. We expect earnings growth estimates to decline as the economy slows. So where does this leave us with our positioning portfolios? Given the elevated risk of recession, we have positioned portfolios with an underweight position in both domestic and international equities and an overweight exposure to high-quality short-term bonds and cash, given the yields that we can achieve. On this chart, I just want to focus on 2 points. First, if you follow the headline inflation reported over the last year, there's been a steady and significant decline down to 4.9% in April. However, when you look at the bottom four categories of food, other, which is mostly our services, restaurants, and housing, we can see that across over the last year that the year-over-year inflation has actually increased, even though we had a slight peak and it's come down a little bit. The Fed right now is more focused on core CPI, these bottom four categories, which are stickier parts of inflation, including housing, services, travel, food. Until the Fed sees a steady decline in this line, it is unlikely that the Fed will be comfortable in cutting rates. We've been showing this chart for over a year now, and this is the first month where we have been able to show the current Fed funds rate higher than CPI. Historically, the Fed has not stopped a rate hiking cycle before its key rate has moved higher, often significantly higher if you look at prior cycles, than CPI. This gives the Fed the option of pausing, which we think the Fed is likely done for now. But we will still get another inflation report and another jobs report before the next Fed meeting. So although a pause is justified, it's hard to say that it's guaranteed just yet. During the 1970s, economists and policymakers believed that they could lower unemployment through higher inflation. The Fed pursued what economists would call stop-go monetary policy, which alternated between fighting high unemployment and high inflation. During the go periods, the Fed lowered interest rates to loosen the money supply and target lower unemployment. But inflation was the result. During the stop periods, when inflation mounted, the Fed would raise interest rates to reduce inflationary pressures. The trade-off proved unstable in the long run, as inflation and unemployment increased together in the mid-1970s. We expect the Fed is willing to stay aggressive as long as inflation stays stickier and more persistent than expected just a few months ago. The Fed does not want to repeat the stop-go policies of the 1970s. We believe the Fed is willing to risk a recession in order to fight inflation. That is clearly their top priority. One of the issues that the Fed has had is that the markets have not believed its messaging and guidance. Fed members have consistently messaged that they expect to keep rates at peak levels through 2023. However, after the banking crisis in March, markets have been pricing in that the Fed will begin cutting rates through 2023. That they'll begin this summer and that the Fed will likely cut by 1% or more by January of next year. Markets have been cheering the possibility of a pause with the expectation that a rate cut could quickly follow. However, historically rate cuts have not been a positive event for the stock market. U.S. stocks have done okay after a pause, on average up mid-single digits over 3 to 4 months, but after the first rate cut, the S&P 500 has declined over 20% on average over the next 8 to 10 months. Historically, the market has not bottomed before a recession or before the first rate cut. The Fed is typically cutting rates because economic conditions are deteriorating. So a pause and even a rate cut does not mean that we've achieved a soft landing. As I mentioned, many recession indicators are flashing red. One of those is that the yield curve is inverted at the most extreme levels that we've seen in a very long time. As a reminder, the yield curve represents yields at different maturities, such as 1 month, 6 months, 2 years, 5 years, 10 years, and out to 30 years. In normal markets, investors would expect to achieve a higher yield as an investor increases the maturity. However, right now the highest yields available are on the shorter end of the curve, the 1 month, 3 month, and 6 month yield. Yields are 1.5% lower or more as you go out to the 10-year Treasury as compared to short-term Treasury yields, as an example. This chart shows the yield curve inversions comparing the 2 and 10-year Treasury as well as the 3-month and 10-year Treasury yields. This tells us that the bond market is pricing in a recession. That is the outlook. However, the stock market is pricing in a soft landing. In other words, the bond market is expecting a quick and sharp decline in economic activity, while the stock market is expecting that anyone who wants a job will be able to keep a job and therefore be able to keep spending until inflation drops. This is a very unique dynamic where both statements are currently true. Over the last year, we have seen a significant slowdown in sectors of the economy, such as tech, housing, and manufacturing. It hasn't been a drop off a cliff all at once, but more of a rolling recession through different parts of the economy over time. And during the same time, the job market has stayed remarkably strong, which has kept the U.S. out of a broad recession. This is the needle that the Fed is trying to thread, and so far it has worked. We look closely at the leading economic indicators to evaluate the prospects of a recession. We have now had 13 consecutive months of negative LEI readings. If you look at the left-hand chart, the gray bars represent prior recessions. Looking at the current decline, it certainly looks like we could be in a recession. But as shown on the bottom right-hand chart, which consists of coincident economic indicators, we can see that the job market is holding up and is supporting consumers and the economy in the face of several economic headwinds. Coincident indicators try to represent real-time changes in the economy, and there's still a strong trend in the jobs market, whereas we can see weakening trends in most other areas of the economy. There have been several contributing factors to the inflation we're dealing with, including supply chain issues, but it's hard to argue that a main contributor was not the unprecedented flow of money from the Fed and Congress to support the economy. Here the chart shows the historic increase in money supply from the beginning of 2020 to early 2021. The supply growth has significantly decreased over the last 18 months. You can now see that the money supply has gone into negative territory in 2023. I will also point out that the peak in money supply growth was about the same time as the last fiscal bill passed during the pandemic. But inflation did not peak until almost 6 months later in June of 2022, or 16 months later in June of 2022. This shows the lag effect of monetary and fiscal policy. This leads me to two conclusions. First, the slowdown in money supply should continue to put downward pressure on inflation, which is good. The second is, however, not as positive in that the slowdown should also continue to weaken economic growth and put pressure on the jobs market. Now let's move to the banking sector for a discussion, which will play a key role in the economy over the next year. This chart shows that banks have been unable to raise their deposit rates, unlike money market accounts, since the Fed began to raise rates. To simplify the situation, let's use an example bank that has originated home loans over the last 5 to 7 years. Most of these loans were either 15 or 30-year fixed rate loans, maybe as low as 2.5% to 3%. So they are still collecting money monthly interest payments at very low yields because few people are refinancing into higher rates and home sales have declined. But the Fed has drastically increased short-term rates to 5%, which money market accounts can more easily adjust their yields upwards because most of their investments are short-term. So depositors are demanding higher deposit yields, but the bank's income is mostly based on low-yielding mortgages. It's easy to see that this is not a profitable business model, and that is one of the issues hitting banks. If they had to sell their mortgages right now, they would be worth less than when they made them, and this has spooked the markets and also depositors. So attractive alternatives were leading to deposit withdrawals from banks, and the speed at which investors can move money today was a dynamic banks and regulators were not prepared for. This chart shows the growth in deposits between money market accounts and regional banks. Money started moving from banks to money market accounts last summer as the Fed quickly raised rates. Regional banks held steady for most of 2022, but starting in 2023, the withdrawal pace quickly picked up and added pressure on banks, which led to the initial bank failures. The initial bank failures and the pressure it put on the markets increased the financial stress across the economy. There are several indices that gather underlying information to measure financial stress across time. Here are two that look at lending conditions, asset prices, credit spreads, among other data. As you can see, there were sharp spikes during the tech bust and also the great financial crash in 2008, as well as during the pandemic. In March of this year, we saw another spike in financial stress. We believe the current stress on the banking system is going to have a meaningful impact on consumers and businesses into next year. Because banks are concerned about their own financial condition and it's harder to raise capital in this environment, they have pulled back quickly and significantly in their ability to lend credit. This chart shows the lending standards that have quickly tightened across consumers and businesses. From the most recent loan officer survey, we also expect that conditions will continue to tighten through 2023. So although the Fed may pause with additional rate hikes, the reduction in credit to the economy through banks is going to keep the economy in restrictive territory. And this is important because, as we can see in small business data, tightening lending conditions have often been an indicator of future job losses and economic weakness. Although the weaknesses show up with about a 2-quarter lag. That would mean we expect to see pressure on the job market continuing into early 2024. But for now, the job market remains strong as shown in these charts. There are still more job openings than we have unemployed people. The economy is still adding jobs every month. And we have seen a tick up recently in weekly unemployment claims. So we'll be watching this closely to see if the initial cracks in the job market are expanding. But as we can also see in continued claims, people who are looking for a job have been able to find one for the most part in a reasonable amount of time, as continuing claims have stayed fairly consistent this year. With unemployment stable around 3.5% for most of this year and near all-time lows, We believe this dynamic will make it hard for the Fed to cut rates anytime soon. In looking at the last 50 years of Fed history, the Fed has cut rates over 120 times, but less than 25 times have they cut rates with unemployment below 5%, and they have cut rates with unemployment under 4% less than 5 times. Without a significant move higher in layoffs and unemployment claims, we think the Fed will follow its current message and leave rates higher for longer. To end this first section on another positive note, there has been some positive momentum in PMIs, which represent trends in the manufacturing sector. As I mentioned earlier, manufacturing saw a significant decline in activity last year, as shown by the red and orange squares here under 2022, really across the globe. But this year, not only in the US, but really broadly across the world, it's a sign that businesses and consumers are withstanding the economic strain of higher rates, as we're seeing measures above 50, which represent an expansion in manufacturing. The Fed is hoping that this will hold until it gets inflation back down closer to its 2% target.
Thanks, Ross. My name is Ford Donahue, and I work with Ross and the investments team at HB. So far, Ross has walked through some of the main trends that are driving the economy in 2023. I'm going to spend some time talking about how these trends are impacting our outlook for the equity markets, and then spend some time taking a look at what is going on in economies overseas, outside the US, before handing it back to Ross for some final thoughts. First, let's take a look at the underlying fundamentals in the US equity market. Over time, returns in the equity markets are driven by growth in corporate profits. So for us, it is important to monitor trends and outlook for earnings growth. This chart looks at recent historical earnings growth in 2021 and 2022 and projected earnings growth for 2023. We are breaking up quarterly S&P 500 earnings growth numbers into their two main components, sales growth in tan and margin growth in maroon. Sales growth is a great indicator of the underlying strength of the US consumer, while margin expansion or contraction shows the impact that moves in rates, inflation, and input costs are having on corporate profitability. If we look back to 2021, we can see that both top-line sales growth and margins were strong, leading to record earnings growth numbers of over 30% for the year. It seems like a long time ago, but we can all remember 2021 was somewhat of a Goldilocks environment, where the US economy was recovering out of the COVID lockdowns and consumers had excess savings to spend on goods and services. This led to strong sales growth for US companies. At the same time, inflation remained subdued and interest rates were at record lows, allowing corporations to expand margins. Turning to 2022, we continued to see positive sales growth, indicative of a strong consumer and robust labor markets. But throughout 2022, we saw margins contract as interest rates rose and inflation started eating into corporate costs such as wages and raw materials. These two factors combined to produce low single-digit earnings growth for the year. Shifting to 2023 on the far right of the chart, we can see that margins remain under pressure due to elevated rates and persistent inflation, and unfortunately, we're finally starting to see declines in sales expectations as consumers moderate spending as we head through an uncertain economic environment. All of this comes together to form a weak outlook for corporate earnings growth in 2023. We would expect flat growth or potential modest declines in equity earnings this year. The flat to negative outlook for corporate earnings will likely be a headwind for the market returns as we head through 2023. This next slide is still looking at earnings data for the S&P 500, but is following the trend and expectations for earnings as time has passed. For example, the tan line on this page shows how the expectation for 2023 earnings for S&P 500 companies has evolved over the year. 1 year ago, in May of 2022, analysts expected the S&P 500 to produce $250 of earnings per share in 2023. But over the last year, this has slowly drifted down towards a current level of $219, representing just 1% growth over 2022 earnings. As mentioned earlier, we would not be surprised to continue to see these earnings estimates drift lower throughout the year and to actually see slight declines in earnings in 2023. The maroon line shows expectations for S&P 500 earnings in 2024. As you can see, this line has also trended slightly lower over time, but remains well above the tan line as the market is currently pricing in about 12% earnings growth in 2024. If a recession were to materialize later this year, we would expect these 2024 earnings expectations to drift lower from these levels, and this would be a further headwind to returns in the months ahead. Next, let's take a look at valuations in the public equity market. Valuations help us get a gauge for how cheap or expensive stocks are. We look at a variety of metrics to measure valuations, but today I wanted to show a commonly used valuation metric called earnings yield. The earnings yield looks at the earnings generated from an investment and divides that amount by the price that is being paid for that investment. Simply put, earnings yield is the earnings that are being generated for each dollar invested. A higher earning yield indicates that an investment is cheaper, while a lower earnings yield indicates that an investment is more expensive. This is a particularly important valuation metric to monitor at this time because we can compare the earnings yield in the S&P 500 to the rapidly rising yields that can be generated on cash and fixed income investments in today's market. This chart looks at the earnings yield on the S&P 500 over the past 20 years. We can see that over this time, the yield has averaged about 6.5%, has been as high as 10% during the Great Financial Crisis, and as low as nearly 4% during the recent market run-up in 2021. Today, the earnings yield on the S&P 500 is just about 5.5%. This is slightly lower than historical averages, and in our view is by no means cheap, given the currently uncertain economic environment. This slide is showing the exact same S&P 500 earnings yield chart, but now we're overlaying this with the yield that can be generated on cash, as measured by the 3-month Treasury bill. If we had to choose one chart that explained the sell-off in equity markets in 2022, this would be on the short list. As you can see, during the sell-off in 2022, equity earnings yields rose modestly from a little bit over 4% to the current level right around 5.5%. However, at the same time, the yield on cash rose from a low of nearly 0% to almost 5.5% today, almost matching the earnings yield that we can generate on equity investments. That is a phenomenon that we have not seen since before the tech crash in 2000 and 2001. As you can imagine, on the margin, this leads investors to pull dollars out of stocks and move that money into cash and bonds. Taking a step back and thinking about the information that we have talked about so far, we believe that we are in an environment with an elevated risk of recession. We believe that recession is going to impact corporate profitability this year. At the same time, valuations on the equity market are not cheap, and the yield on short-term, high-quality fixed income instruments is as attractive as it has been in 20 years. All of this has led us to take a cautious view on the stock market this year and led us to be generally underweight stocks and portfolios, instead favoring an overweight position in short-term, high-quality bonds. Now, let's shift our focus away from U.S. markets and look at what is driving markets outside the U.S. in both Europe and Asia. The chart on the left-hand side of this page compares the total return of the U.S. equity market, as measured by the S&P 500, to the total return of the MSCI EAFE index, which tracks stock markets in Europe, Asia, and the Far East. Over the last 10 years, U.S. equity market returns have far outpaced the returns from international equities. In the time span between 2012 and 2022, on a total return basis, the S&P 500 has returned nearly 280%, compared to just an 85% total return for the MSCI EAFE. U.S. outperformance has been driven by incredible earnings growth and returns amongst some of the largest U.S. companies in the technology sector, a flock towards U.S.-based assets in an uncertain world, and a stronger overall economy here at home when compared to most countries outside of the United States. However, shifting to the right-hand side of this page, we have seen a bit of a shift towards international equities outperforming over the past 6 months. Off of the market bottoms in September 2022, the MSCI EAFE has returned over 30%, compared to a total return of below 20% for the S&P 500. Given this reversal, we wanted to spend some time highlighting some of the dynamics driving this recent performance and give our thoughts on the outlook for investing overseas. First, let's take a look at Europe. If we think about the main forces driving the U.S. economy and markets right now, it's inflation, rising rates, a strong labor market, and concerns about a looming recession. At a high level, we're seeing very similar dynamics in mainland Europe and the UK. The chart on the left of this page shows recent trends in both core and headline inflation in Europe. Very similar to the US, we saw a sudden spike of inflation in late 2021 to levels not seen in decades. As we look at the right side of this chart, again similar to the US, European headline inflation has declined from a high of over 10% as energy prices have come down. However, core inflation continues to tick higher. Core inflation tends to be more closely monitored by central banks as it strips out volatile components and shows a true picture of the underlying inflationary pressures in an economy. Shifting to the right side of this page, the continued pressure from core inflation has led the European Central Bank to end its experiment with negative interest rates and raise rates rapidly over the past 12 months to a level of about 3.5% today. Similar to our outlook for US markets, we believe that elevated inflation and tight monetary policy are likely to be headwinds to economic growth and market returns in Europe looking forward. At the same time, we have also seen a post-COVID boom in employment in Europe that has decreased the unemployment rate to multi-decade lows and sent wage growth back to levels not seen since the financial crisis. While there have been concerns that the war in Ukraine would cause a recession in Europe in 2022 or 2023, we have seen strong employment and wage growth lead the economy to perform better than feared, and this has been one of the drivers of the recent recovery in international equity markets. While up to this point, the European economy has held up better in the past year than many have expected, there are a few risks that lead us to remain cautious on European markets looking forward. Looking at the chart on the left-hand side of this page, one big difference between the US and European economies is that a large portion of residential mortgages in Europe are floating rate, as opposed to the US market, which is dominated by fixed rate mortgages. This chart shows that 40% of mortgages in the UK are currently floating rate, and nearly 100% of mortgages currently outstanding will be floating rate by the year 2027. This means that if inflation remains elevated and policy rates remain higher for longer, the consumer in Europe is likely to suffer as they will be strapped with higher mortgage payments in the coming years. Second, the war in Ukraine continues to have a material impact on the European energy market. The chart on the right shows the sudden and dramatic rise in the cost of natural gas on the European continent this past winter. These prices have eased recently, as this past winter was very mild in Europe, helping to support the economy so far in 2023. But Europe has not found a long-term solution to replacing the natural gas that it once imported from Russia. And if this coming winter turns out to be colder than the last, there could be widespread ramifications for the European economy. In summary, the current economic setup in Europe has many similarities to what we're seeing in the US. Inflation is stubbornly high. Central banks are tightening policy to respond. There are fears about a potential recession, but a strong labor market has kept the economy afloat. However, several unique attributes of Europe's economy are creating additional risks that aren't as prevalent in the US. All of these factors combined lead us to have a cautious view on the outlook for the European economy and European markets. Now, let's turn to Asia, where the current economic environment is quite different from what we're seeing in both the US and Europe. In both Japan and China, Asia's two largest economies, inflation has been less of an issue in comparison to the US and Europe. As a result, central banks have actually been able to keep interest rates low and stimulate their economies. Additionally, China is in the midst of reopening its economy after rolling COVID lockdowns over the last 3 years, and many economists expect growth in China to accelerate in 2023. This chart shows both inflation in maroon and central bank policy rates in tan across the globe. Starting on the left, inflation in China has been almost non-existent in the past year. As a result, the major policy rates in China have actually come down slightly as the government attempts to help the economy recover from sluggish growth in 2022. Moving to the right, we have seen some inflation in Japan in the last year, with the current 12-month rate of inflation at about 3.5%. But this is nothing compared to what we are seeing in the West, with inflation rates reaching as high as 10%. Japan has so far been the only major central bank to keep its policy rates at zero, and has been willing to accept this modestly elevated rate of inflation to continue to attempt to stimulate economic growth. Continuing to move to the right, you can see that the US has gotten its Fed funds policy rate up to 5%, finally catching up with the rate of inflation. We expect the Fed to pause its rate hikes now that inflation is at or below the Fed funds rate. Europe and the UK, on the other hand, are continuing to see rates of inflation far higher than their policy rates. As a result, the consensus is that European central banks are likely to need to continue tightening policy in an effort to fight inflation throughout the course of 2023. This dynamic will have a significant impact on economic growth in 2023. As Japan and China are facing less inflationary pressures and have central banks that are either remaining stable or easing policy, the expectation is that economic growth will either hold steady at 2022 levels, or in the case of China, increase materially in 2023. While the US, Europe, and UK are all expected to see declining growth rates in 2023, as the impact of higher interest rates feeds through the economy. While the short-term outlook for major Asian economies looks more favorable than what we're seeing in the West, there remain significant headwinds to long-term economic growth in both Japan and China. Historically, one of the main drivers behind investments in the emerging markets, and Asia more specifically, were the benefits of a growing population. However, the chart on the left shows that China, which is the largest country in the Emerging Markets Index, recorded negative population growth in 2022 for the first time in 60 years. This is mainly due to the impacts of China's one-child policy, but is also driven by China's evolution from a more rural, agrarian economy to a more urbanized population. As China's overall population begins to decline, India just passed China this year as the world's most populous country. This decline in population is likely to continue for years to come and will lead to a decline in the potential growth in the Chinese economy over time. Historically, we have been used to economic growth rates of over 6% in China and many Asian markets, but these numbers are likely to decline into the future to rates more closely resembling what we see here in the US. Looking forward, a declining population will be a major headwind towards economic growth in Asia and China more specifically. And this risk counteracts some of the positives that we're seeing in the Asian economy in the short term. With that, I will turn it back over to Ross for some final comments.
On our last slide, I just wanted to end with a quick reminder that although we talk about our views on the economy, recession risk, stocks, and bonds, one of our most important messages will always be for clients to stick to their financial plan even in volatile times. This chart looks at the last 50 years, and the x-axis has annual stock returns and the y-axis has annual bond returns. The band for each shows a plus or minus 2% range from the average annual return over the last 50 years. So the average annual stock return is about 10%. And you can see that we have rarely had annual returns within the band. Stocks are volatile year to year. We've only had 1 year when we have achieved the long-term averages for both stocks and bonds in the same year. Rarely are average returns achieved in any given year. At the beginning of this year, everyone was predicting a recession, but here we are in May tracking pretty close to average returns for both asset classes for the year. It's an important reminder that all of this volatility is expected and it's built into your long-term financial plan. Once again, thanks for joining us for this presentation. If you have any further questions, please reach out to a member of your client service team.